risk tolerance as well as an options specialist here at Simpler Trading. And in today's session, I'm going to be walking through S&P and talk about what the market is doing and what and what looks good here overall, and what we might see as well in the future. So let's go ahead and focus in on SPX. Now, I do want to actually take a step back here from the daily chart for a second and pull up my intraday charts just to show that on the intraday setup, we do have a lot of squeezes starting to print. So we have a 10-minute squeeze occurring, which this is my 10-minute chart here. We have a 30-minute squeeze occurring, which we can see on the multi-squeeze indicator up here at the top. And we have an hourly squeeze printing. At this time, right, anything can happen overnight. But at this time, hey, Gus, great to see you in here. Good afternoon. It looks like to me that these squeezes have a good probability of firing to the upside. First, we'll talk about what I'm seeing on the intraday charts to lead me to believe that, as well as what we're seeing on the daily chart. So on the intraday charts, and forewarning guys, I do have my daughter with me as we continue this work from home, so you might hear a few baby noises in the background. Hey Gus, Abby, great to see you. So on the intraday time frame, some of the bullish signs that we're getting is on our smaller time frames. Right now, the price is holding our simple moving averages as support. Those are these yellow gold lines that I have on my chart. So you can see we closed the day above those levels, which is a good sign. We also have on the intraday smaller time frames, the Bollinger Band starting to flare open. So that looks good as well. And both on the 10-minute chart, on the hourly chart, let's take a look at the 30-minute chart really quickly. Not on the 30-minute chart. So the 30-minute chart, we're holding our simple moving averages. Bollinger Bands as well here are flaring open. But back to the hourly chart, we do have a bullish signal on the compound breakout tool. So this here as well usually is a bullish sign that we could end up moving to the upside. So with all these intraday squeezes starting to print, with our EMAs overall being in a stacked up formation, same thing with our simple moving averages. Yes, I think she will agree that this is looking bullish to the upside. Let's go ahead and pull up the daily chart now. So the daily chart, a few things that I like about this going into the close today is, first of all, we closed in a bullish divergent bar. For those of you who don't know, this is an indicator that gives you a good probability that within the next few bars, we'll see some sort of higher high occur. I usually like to give it 3 bars for it to work out. So on the daily chart, that's 3 days. Hey, Sherry. Yes, we do have the baby indicator with us, and she seems to be agreeing with the bullish sentiment that we're starting to see on the intraday timeframes. And like I mentioned, the daily chart is showing that we could bounce back up. What I also liked about today into the close is that we were able to close above the 10-period simple, so that's trying to hold as support right now. We also canceled out of our pullback signal on the compound breakout tool. So it's not a bullish signal, but the fact that it's canceled out of the pullback signal is a very good sign that the bullish trend can continue from here. We also have bullish sentiment on the Awesome Oscillator, with the green bars being above the 0 line, and with room for them to continue to move higher to the top of the axis. Our simple moving averages are in a stacked up formation technically. The 10 is above the 30, and both are above the 100, so that is a bullish formation there as well. The only thing that's still showing slight consolidation as of right now on the chart is the fact that the Bollinger Bands aren't flaring open yet. Now, maybe that will happen tomorrow if we get a nice gap. Yes, a nice gap and move higher. Maybe some of you guys with the bullish divergent bar indicator already, maybe put on a bullish trade into the close of market today, if you're able to catch that. But I would be cautious about how high this can move, right? I do like the idea that it will move higher. Certainly, I like the idea that the intraday squeezes are going to fire to the upside. But we do have some levels that we need to be mindful of. The first level that we need to be mindful of is 3,200. That's going to be a very strong psychological level for the price to go up and test. So we could go up to that level once again and kind of stall out. And the second level above that is right around 3250. We have the ATR trailing stop technically at 3241 on the daily chart showing resistance. That's also right in line with the upper Bollinger Band. So that could be part of the reason why they're not flaring open yet, while we're still seeing potential overall consolidation within this range. And then the weekly chart as well has a level right by 3250 at 3244. So very closely in line with that daily resistance, where we could go up and test it and potentially stall again, right? So the good thing about the weekly chart being in line with the intraday and daily chart is last week, similar situation, we printed a bullish divergent bar. So within the next few weeks on the weekly chart, I am looking for a higher high above 3155. So I do think if we continue with the bullish sentiment, if these daily squeezes and intraday squeezes, can fire to the upside, there's a good probability that this week is the week that we'll see a higher high above 3155 again. And certainly I do think within the next few weeks, within the next month, we'll go back up and test the weekly resistance level around that 3244, 3250 range. Now, if we can break above this level and turn it from resistance to support, that to me looks like good bullish sentiment to the upside. That looks like we will probably start to see at that point the Bollinger Bands flare open, which right now they're not. They're still in consolidation. That we could go back up and test the highs that we had before this whole coronavirus, before the whole oil situation with OPEC leading into the coronavirus and that downturn. Very well could go back and test those higher highs, maybe even start to make new higher highs from there. So that's certainly what I'm watching. Some other things setting up for that potential break in resistance. The 10 period simple is getting ready to cross above the 30. So if we do break resistance, there's a good probability that the 10 will break the 30, and that will start to form a stacked up formation. Momentum has already started to cross back above the 0 line. That too is another bullish sentiment on the awesome oscillator that we could move higher. We don't quite have the signal on the compound breakout tool, but everything else, like I mentioned, is looking good for that move. So the first few levels I'd be careful of, more on a daily and weekly time frame. The levels that I think that will definitely go up and test within the next few weeks or month is certainly 3200, which is that nice psychological level. And if we manage to break above that, 3240 to 3250 to test the daily and weekly resistance levels that we have here. So those are my first targets to the upside on SPX overall. If we can manage to break those, then I like to move higher up to test the prior highs and potentially see an overall bullish sentiment try and form once again in this market, with agreement both in the shorter time frames, like the intraday time frames in the daily chart, as well as in the longer term time frames like the weekly and monthly. Now, I know some people have asked me, certainly I actually did a podcast on this earlier talking about this, but would I still hold hedges in this market environment? And the answer is yes. At this time I would. And the reason why is, one, we haven't quite broken this resistance level yet, right? So if this ends up holding and instead the market starts to turn back down, then we need to be prepared for that. It's always good to kind of have that insurance out there just in case. And I'm still a little cautious about the monthly time frame. I think we talked about this last time. But when we have a break and the ATR trailing stop from support to resistance, the only times that we've seen that in the last 20 years was during the dot-com bubble going into the early 2000s and during the housing recession in 2008. And both of those caused a bearish trend that lasted for about a year before we finally started to pick back up. In this case, we saw the break occur, but notice the monthly range that we had in March, right? We have not seen a monthly range like this in SPX, I don't believe ever. Certainly not in the last 20 years. This is the most volatile monthly range that we have ever seen while trading. So a part of me thinks that this monthly range maybe encompassed that yearly move that it took for a year to the downside to occur back in the early 2000s, that it took roughly about a year in 2008 before we reached the bottom of that move. Maybe that kind of move happened all within 1 month here. It's certainly possible. And we did go down and respect support, so that's a good sign that that could be the case. But it still makes me extremely cautious. And the reason why it makes me cautious here, oh, does it make you cautious too? The reason why it makes me cautious here is because after that initial break, both in the early 2000s and during 2008, we saw the price consolidate for several months at a minimum before it actually took the next step down. So it could be, right, if we aren't able to break above weekly resistance, if that level does continue to hold, that we are actually just in consolidation, you know, very stronger ranges, but in consolidation before the market turns back down. So that's why for myself, I will still be in some very inexpensive hedge trades to play to the downside. And maybe Navi doesn't agree. She liked the bullish sentiment. It seems like a bit more. But to me, it's smart to put on those hedge trades because my overall account is still normally bullish, right? So if the market starts to turn drastically down like it did back here, having those hedges on is going to help protect my portfolio against the drawdowns that I'll see in those bullish trades and still allow for an overall profit. So what are some of the hedge trades that I would be considering putting on right now? Well, let me pull up my option chain. You could either look to do this in SPX or in SPY. But over here on my option chain, what I would do is I would go out at least a month in time. So you could consider the July monthly option. You might even go out to the August monthly expiration. We'll start with July here. And the idea is to set up a bearish trade that has a very small risk to it, right? So it can easily, like I said, is insurance. It can be made up by your bullish sentiment trades. You're not really concerned about losing it. That's kind of the deal with insurance, right? Is I don't mind paying up, paying this little bit, taking it as a debit to my pocket, because if the market moves down, then I'm good to go, right? I have something set up. So as of right now, you might consider going down to 3,000, maybe 2,950, right? Starting with those levels and looking at some very wide wing butterflies. So here, for example, is a 50-point butterfly. Now it's very far out of the money, right? It's over 167 points out of the money compared to the pin. But notice the cost basis. On the SPX, it's only $1.75. The profit potential on a 50-point spread, just on one contract, right, is $4,825 with a $175 risk. So this $175 can easily be made up with the majority of my bullish trades and still allow me an overall profit. While at the same time, if the market starts to tumble, which we know usually when the market tumbles, it really, starts to sell off. We need to be prepared for that volatility. Then this trade can allow me a profit. It can help cover the risk in my mainly bullish trades and still allow me to walk away at least around break even, if not ideally with still a profit in my account for that expiration. Now, let's say this is too much, right? Maybe you don't even want to spend this much on insurance. Well, what I would recommend doing in that case, or what I would personally look at doing, I should say, is going over to SPY. So SPY, similar situation. Go to something like the July monthly expiration. Go out of the money. Keep in mind, for every dollar point in SPY, it's 10 points roughly in the S&P. Go to 29.50, and you could look at a 5-point spread here. So here, our cost basis is only 21 cents, right? 21 cents versus a $479 profit potential. Now, maybe you look to either widen the spread, right? If this isn't going to cover the majority of your portfolio, you could look to widen the spread in SPY. Maybe go with a 10-point width spread. So instead of 2,900, you go to 2,085. Instead of 300, you go to 305. This is still only about a 79-cent cost basis, 921 profit potential. So once again, excellent risk versus reward, doesn't cost you a lot of capital. What you could also consider doing here, if you like the wider width spread, or if you want to do this on the 5-point spread, is also increase maybe your contract amount, right? Here, it's about $158 for 2 contracts, so that's your total capital risk. And your max profit potential is $1842, right? So you could look to build into the trade like that. After pricing out both of those, I think I would prefer the SPX Butterfly personally, because it gives you a much stronger profit potential versus the risk. But I will note SPY butterflies, right? Kind of the benefit to those over SPX butterflies is if volatility does start to pick off, if we do start to sell off rapidly, and it's before that July monthly expiration, which I'm not anticipating in any way, but this is why it's insurance, right? We put this on just in case it occurs. The SPY butterfly will probably gain a bit more in value compared to the SPX butterfly. So it should allow you to close out for a closer profit towards that max profit potential in comparison to SPX, which will probably try to hold on to both the extrinsic value, won't see as much theta decay incurred in it if that volatility picks up quite a bit. So, there are pros and cons to both sides in doing that, but these are the hedge trades I would look at. And yeah, Sherry, butterflies are what I would look at all the way. You could also play it a bit more directionally, right? And if you are concerned about that volatility really picking up, you could look at it just as a straight vertical spread to jump into, right? Here's a 5-point vertical with 300 on SPY for 2 contracts. Or let's just go to 1 contract again. So for 1 contract, it's a 126 risk, 374 profit potential. It's not going to be as good of a risk versus reward, which is why I personally like to lean towards the butterfly on my insurance kind of trades. But if the market really starts to sell off, right, and we just, let's say, go down to 2,800, completely blow past the wings of the butterfly that we set up, this will still allow you a profit. Whereas the butterfly, if you haven't closed it out in time, could still end up being a slight loss for you, which of course is not what we want on an insurance type trade like this. So you could also look at it a bit more directionally, but for myself, I prefer the risk versus reward on the butterfly because it leaves a lot more profit potential and it costs a lot less for my account. This to me is much easier to make up, right, in my account, and it still leaves an excellent profit potential to be taken and help offset on my trades. Now, as I mentioned, I'd probably lean myself a little bit more towards SPX, right, because this is $1.75, so it's not that much more expensive than putting on a few contracts on the SPY butterfly, but notice the profit potential here. Now, I'm not saying I would hold out for this entire profit potential, but the fact that it goes from 175 to 4,825 means that if we do start to move down and hang out within this 50-point range, I could still probably lock in a decent profit, cover a good chunk of my trades, and have that be okay. And at the same time, if the market does move up, if we do end up moving above weekly and daily resistance and going back up to test the highs, then yes, I'll be taking a loss on this trade, but this capital, the capital in the SPY trade that we just walked through, could easily be made up by some of the bullish trade ideas that I have in my account. Yeah, great question, Morris. So how does the account size influence the amount of hedge you put on? So for myself, I try and keep it a very small percentage of my account, right? I'm not looking to go 10% of my account into a hedge, 20%, because I'm not expecting it to work out. Yeah, not a problem, Sherry. I'm not expecting it to work out, right? The idea is that I really don't want it to work out. I want it to be a loss, because if it's a loss, that means my bullish trade ideas should be working out and giving me the profit to cover it and still be growing my account. So you could look at it as a percentage. Certainly, I look at it just as a very small trade capital cost wise. So in the case of the S&P one here, I'd probably only do 1 contract, right? Because the risk that I have out there on my calls would easily be covered by this, or on my bullish trades, I should say, would easily be covered by the 48.25 and still allow me a profit potential to lock in. So that's the way I personally look at it. I know John likes to do percentages of his account. So if I were to do a percentage of this in my account, I'd probably only do 5% maybe of the account and my insurance. Maybe only a couple percentage points, depending on how big the account is. But for me, what I like to look for in insurance is, does the profit potential allow me to cover the majority of the bullish trades I'm in, right? Maybe some are honey badgers, maybe some will still work out, but does it cover the majority of the bullish trades I'm in, and ideally still allow me a profit to be taken if that bearish move occurs? And in this case of this butterfly, I only need one contract on it right now to cover my bullish trades, right? And still allow me a profit on everything. Exactly, Sherry, exactly. So it's very small insurance premium, only $175 in this case, but very large profit potential. And like I said, if this started to really sell off, if I was concerned it was going to move below 2,900 before July, I would look to take it off for maybe a $5, $10 profit, lock it in, and then just readjust my butterfly trades lower. And if the market was really selling off like that, of course, I'd probably be looking at some bearish trade ideas too. But then I would just stair step down, right? So if I took a profit on that, I would go with something like the 2850, 2800, 2750, right? Just reset a new butterfly out there and continue to play it to the downside until it either seems like we've found a bottom, much like we did here back in March, or it starts to stall and consolidate as support. And then I can reevaluate my overall trades. I can reevaluate my overall chart and see if that's a good opportunity maybe to buy back in. So overall, if you were to ask me what my sentiment is, I'm still very much bullish right now in this market. I still think that we have a stronger probability of breaking above this resistance and going back up to test prior highs before the end of the year. But we never know what this market's going to bring, certainly with coronavirus cases seeming to be spiking up, right? We don't know if another stay-at-home order will cause, this kind of economy to take a pause again, if the market will react negatively again to that. So in this kind of market environment, you just always want to be prepared. Like the Girl Scout motto states, right? Always be prepared. And I like to be prepared not only in other aspects of my life, like at home, but also in my trading plan. So by having this insurance out there, I'm prepared for a down move, but I'm not necessarily anticipating a down move. So I hope that guy gave you some levels to look at. Certainly, if you wanted to put on some bullish trade ideas, right now in this account, I actually have a bullish trade idea based off the weekly chart in here for the July 10th expiration. It's just a simple out of the money long debit call vertical spread. It actually holds a small profit in it right now. But the idea, of course, on this trade is that we'll get back above 31.55, go up towards 3,200. That puts the spread in the money. It's a very low risk trade and would still allow for a very nice profit potential to be taken on it. So these are some ideas that you could also look at if you are in agreement with me and think that the price is going to go back up to 3,200, 3,240, 50 range to test at least resistance. Maybe not break above it, but at least test those levels. You could look at small out of the money spreads like this to play up to the upside. And at the same time, still have that insurance hedge out there. Just with this trade alone, right? Even if you were to get into this trade today, notice that the risk is 240. The max profit potential on this trade is 260. And just in this one trade alone, still with one contract, if we do see that move within the next few weeks to retest this level, this right here alone covers the risk that we put out there on the insurance trade, right? It would completely cover the risk here on the butterfly and still actually allow for a profit. So just with one trade, I can cover the risk here. If we do continue to be bullish, I can cover the risk, still allow for a profit, and then still have this sitting out there as my insurance for the month. And for me, until we really start to break back above these weekly resistance levels, And until we start to see a little bit more agreement, like the Bollinger Bands flaring open, maybe a bullish signal on the compound breakout tool, I'll probably remain having these insurance kind of trades out there for the time being. If we start to get back up to prior highs and move above them, certainly I probably won't be putting on any more insurance or hedges. I'll just be playing mainly bullish to the upside until we start to get a sign of, okay, maybe we're stalling out here. Maybe we're taking a breather, kind of like we did back here. Or back here, where, okay, we're stalling out, we're at exhaustion levels. Now I might need to put on that insurance again just in case. But for right now, my short-term view, especially with those intraday charts setting up with the squeezes, is still overall to the upside to at least test 3,200, 3,250 range. And if we do manage to break above that, I think we're going to continue higher to the prior highs to test those. So that's kind of my market view right now. Of course, for those of you who like to track NDX or RUT, on NDX, we've already passed the prior highs. I would definitely be a bit more bullish on this. This is why my hedge is also on SPX, because NDX, to me, is looking very bullish right now. This is a very bullish sign when we break the ATR trailing stop on the weekly, turning it from resistance to support. That's a move. If you took the weekly bullish divergent bar here, we're very close to already making the higher high. Maybe you already took a profit on that trade. On the monthly time frame, right? Unlike on SPX and RUT, NDX never broke the ATR trailing stop. So on the tech side, there was no sign to really ever get bearish in the overall market view. Yes, we had a pullback to support, but support held beautifully and we bounced back up off those levels. So this is why also, for those of you who might have caught my TDA network, or maybe I've been listening to the podcasts I've been on recently, I've talked about how I'm more bullish in the tech sector, right? Amazon, Microsoft, Apple, all of those, to me, I'd still be playing to the upside. And I know there are some traders out there saying, well, we're already so high. Why would you keep playing these higher? And it's because the trend's telling me to do so, right? I don't want to fight the trend on these symbols. The trend still remains bullish. Support levels are still holding. And certainly on the tech side of things, right, if, God forbid we do have to go back into some sort of lockdown, the tech side won't be as affected by that. Because if anything, we're using technology more at our homes, right? We're using Amazon Prime deliveries now instead of going into stores to be able to still live our life. So that, to me, I wouldn't hedge an NDX or the Qs. I'd still be playing that bullish. Andrew, great question. So over to SPX again, what's my opinion on an unbalanced butterfly? You could look at an unbalanced butterfly here. My concern, though, with unbalanced butterfly as hedge trades is if the market really starts to sell off, you have the risk that if it gets below your short strike, you could start to incur that capital cost. So here, for example, is just a 25-point spread, a lot more narrow than the 50-point spread that we were looking at out for the July monthly expiration. Still the same pin around 29.50. Currently, it's showing about a 390 credit. That's certainly not bad. If the market does continue higher, great. That's going to eventually see theta decay and lock it in as a profit. If the market moves down and stalls at your pin at 29.50, then you have the max profit potential of the width of the spread, which is 25 points, plus the 390 credit you get. That's how we get the 28.90 here. But the concern is if the market really drops, it could start to break below that. And look at the max loss, right? The max loss would be the 25-point width of the spread minus the credit. That's 21.10. This, to me, is not a low hedge trade. Because if the market really does start to sell off, then this, too, could end up being a loss for my account rather than a profit, right? Let's say within the next 2 weeks, the market sells off. Well, more than likely, I won't have gotten the theta decay on this trade to have given me a profit on it, right? Or it would be maybe a very small profit. And if that volatility picks up to the downside in the market, if it picks up an SPX for a move lower, not only are my bullish trades then hurt, but so is potentially this trade as well. So this is why for insurance trades, I try and stick to standard butterflies because the risk is not as great, right? The max total loss is not as great, and it still allows for an excellent profit potential for that move lower if it occurs. And then really quickly, let's go to IWM as well. Right, IWM is definitely the weakest out of, or IWM. Let me look at RET as the big index. IWM, of course, is the ETF to it. This, of course, is the weakest out of all of them. But even this is trying to pick back up on the monthly time frame. Now, we're right at resistance levels, right? So maybe if you want to hedge, that could work out, maybe still give you a profit compared to the S&P or compared to the NASDAQ. Maybe you do it in RET. If I were to do a hedge in here, I'd probably go to the July 24th expiration just because the July 17th still expires in the AM. I like to have that day to be able to trade it that into close on Friday. So where the SPX gives me the PM expiration, and RET I'd probably got to July 24th, just give myself a little bit of extra time. And in this case, to move down, I'd probably go down to around 1350. Let's price that out, 1300 and 1400 as the wings. Here it's about a 275 cost basis, still an excellent profit potential of 47.25. It's a little bit more expensive, but that's because RUT, the Russell, is a little bit weaker than the S&P. So it has a better probability of maybe working out if you're really concerned about the capital that you're putting in as insurance, which I stress that word as insurance because you shouldn't be worried about that capital. It should be a small, in my opinion, it should be a small capital amount that can be easily made up. But if you're concerned about it, you still want to try and be able to take some sort of profit if we do move down. RUT might be the one to go with for you then. It does cost about $1 more. So keep in mind that's $1 away from your profit potential. But if we were to see a move down back to 1350, if we were to see a move down to the 100 period simple, which is around 1260, close to that 1300 psychological level, you could probably look to take a quick profit in this too and help it be a hedge for your account as well. So that is what I would be looking at. And like I said, this is purely insurance, guys. It's not the idea that these trades will work out, right? It's the idea that if the market tumbles, you have this out here to protect your mainly bullish positions overall. So that's why I still am looking at a potential hedge for my account, right? The last hedge I was in, that completely expired worthless. So it was, a loss overall. But with all the bullish trades I had, with the profits I took, it didn't really affect my account balance, right? I was still profitable for the month. I was still able to lock that in. And now I just move on to a new hedge trade idea. So if you're really concerned, maybe you put it in RET. For myself, I personally plan to still stick with the S&P. And until we really start to break above these levels and look like we're going back to the prior highs like NDX was able to, I'll still keep that insurance out there. Once we start to really break above these levels, when things start to appear bullish in all of our time frames, which they're starting to attempt to go back into that range, then I'll probably take off the insurance. I won't put it out there anymore until we start to see levels of exhaustion again, right? Or signs that we're starting to sell off once more. So thank you guys for joining me in this session. I apologize about my daughter. She maybe yelled in your earphone. Hopefully you guys didn't have the volume too loud or anything like that. But I will say the baby indicator agrees with the bullish sentiment. So, she's been right a few times before. We'll see if she is this time. But thank you all for joining me. As always, have a great rest of your trading day. For those of you who are curious about, the risk, right? If you've ever struggled with risk, I've certainly struggled in the past myself. When I first started trading, I thought I had a grasp on trading. I was doing pretty well starting off with, and then got into a losing trade and it just ate up my profits and I was shocked by it. So with the title of Director of Risk Tolerance, certainly risk is one of the main things I focus on, which is why even in these hedge trades, I'm keeping my risk very small versus the max profit potential. So if you've struggled with risk or you are interested more about my strategies that I like to use, like my intraday strategy on how to day trade without necessarily taking those day trades, right? How to be able to take those intraday moves in smaller accounts and avoid the day trading rules, or you're interested in some of the indicators that we talked about here, Feel free to catch the recording of the free webinar I did last week. I'll make sure to post that here into the chats. But feel free to watch that video. In it, I talk about overall risk, how I've determined what helps me keep and be mindful of risk tolerance in my account, how I never overinvest in my account and I'm still able to take profits, being very conservative about it. And at the same time, talking and introducing that intraday strategy without day trading, as well as some of the indicators. So feel free to look forward to it. Yeah, I'm looking forward to the class too, as well, Bartlett. Very excited for it. That will be this Saturday. But yeah, thanks y'all for joining me. I had a lot of fun doing these sessions. Have a great rest of your evening. As always, for my Star Wars fans out there, may the trade be with you. And hopefully I'll talk to y'all again soon.